To the casual observer, the American consumer engine operates with frictionless precision, a continuous flow of commerce meeting every demand. But in February 2026, the Department of Commerce released a data point that disrupted that rhythm. Retail sales registered a stagnant 0.0% growth rate. Beneath this flat line is a stark divergence in spending behavior. Walmart continues to absorb middle-class households trading down for basic necessities, while discretionary giants like Target are reporting rapid sales declines. This 0% growth rate, occurring even while the labor market remains relatively tight, indicates a disconnect between a household's employment status and their actual discretionary income. The catalyst for this freeze lies outside traditional economic metrics, hidden within unregulated buy now, pay later platforms functioning as a shadow credit market. This chart illustrates the explosive trajectory of BNPL loan origination volume. After years of flat activity, the sector went nearly vertical, surging from about $3 billion in 2019 to over $45 billion by 2023. Because these massive loan pipelines bypass traditional reporting agencies like Experian and Equifax, they remain largely invisible to institutional risk models. Policymakers are attempting to manage the broader economy without a complete ledger of household liabilities, ignoring the accumulating pressure until it overflows. Consider a household like the Millers in Ohio. Despite earning $100,000 a year, they now rely on short-term installment loans to cover basic utilities and veterinary expenses. They represent a growing demographic. By early 2026, 29% of BNPL users reported utilizing the service to pay for groceries. This animated breakdown shows how splitting a $400 grocery bill into 4 equal payments alters buyer psychology. A 10% price hike is $40, but divided into quarters, it registers as a highly manageable $10 increase on the initial payment, masking the true severity of inflation. Moving this math into a digital app interface creates emotional distance. The physical friction of handing over cash is replaced by gamified rewards, severing the psychological pain of the transaction. This inverts the financial restraint of old retail layaway programs. Rather than saving up and waiting for a purchase, the buyer receives the goods immediately. Sustained inflation has pushed households to prioritize immediate survival over future solvency, effectively blinding them to the aggregate weight of the obligations they are stacking up. As consumers exhaust their available microloans, they pivot back to traditional revolving credit to fill the gaps. They are stepping into a hostile borrowing environment. As of February 2026, the average credit card interest rate sits at 21.52%. Yet their capacity to borrow keeps expanding. Researchers at King's College London found that roughly 4 in 5 credit limit increases are not requested by the consumer, but are initiated autonomously by the banks. The predictive algorithms extending these offers actively target users carrying balances month to month, prompting borrowers to increase their debt loads by an average of 30%. The financial architecture is systematically maximizing middle-class leverage, deploying artificial intelligence to inject $40 billion in new debt capacity every quarter without explicit user consent. The timeline eventually catches up with the Millers. Their liquid capital depletes, and a scheduled microtransaction fails to clear. This localized failure is occurring at scale. Nearly half, 47%, of all BNPL users reported making late payments over the past year, a sharp acceleration from 2024. In response to mounting delinquency data, fintech risk models simultaneously throttle accounts and freeze credit lines across the country. This automated evaporation of microcredit translates directly into the 0.0% retail flatline recorded in February. These automated risk assessments effectively dismantled the microcredit infrastructure that had been fueling consumer spending, leading directly to the stagnation seen at checkout. The resulting corporate fallout is already visible. Retailers exposed to discretionary spending, like Target, are actively slashing supply chain roles to brace for a prolonged slump in demand. The Federal Reserve is left with few mechanisms to intervene. They cannot lower interest rates to stimulate the retail sector without aggravating persistent service sector inflation and compounding an increasingly heavy federal deficit. While traditional credit scoring models like FICO are finally moving to incorporate buy now, pay later data by late 2026, the regulatory oversight arrives after the damage has materialized. The standard of living maintained by the American middle class over the past several years was largely financed on an installment plan, and now the primary engine of the global economy has exhausted its credit.